3, 2, 1. Right. I sense we are nearing the end, nearing some satisfaction of getting to a share price. So in this video, we are going to calculate our free cash flows from our profit after taxes, and we're going to apply weighted average cost of capitals and some growth rates, but we are going to very quickly narrow this down to a single value. We're looking for a share price for our company. So the way we're going to do this is we're going to set up this colored table, and we're going to bring the profit after taxes, press Control square brackets, and you'll see I'm going to bring this row here, row 37, profit after taxes. That's the thing I'm going to bring down to start calculating from. Note that it does still include the dividend. Let's go back. I've got to make a couple of adjustments here. These are shown on the left-hand side. We are going to be calculating free cash flow to the enterprise. Okay, and so what we're going to do is go and add back the depreciation. It's a non-cash item. We are going to add back the interest expense. Add back the interest expense, and it's the interest expense after tax. Okay, it's the one minus the tax rate. We're going to add that back. And similarly, for any monies that we've received, we're going to subtract that. And that's also going to be the after-tax portion of it. Then, coming to the more important parts, the CapExes and the amounts of money that we need. Let me press Shift Control U here, and you'll see that here we want to calculate the current assets, okay, now less the current assets in the year before. That's really what we want to change. We want to subtract any increase in those current assets, because that's going to actually cost us some money. It's going to reduce our free cash flow. But we want to make some slight adjustments here. Not just any old assets. We want to subtract out any spare cash. Cash and equivalents minus required cash will be left as spare cash. So this is total current assets minus spare cash, less in the prior years the total current assets minus the spare cash. So there are a couple of brackets and things that you're going to have to get used to here. Right, Shift Control U. That was with assets. We've got to do a similar thing with liabilities. It's easier. We're going to take our current liabilities now and subtract off last year's current liabilities and add that back. You can see that liabilities actually are a good thing for free cash flow. And then what's often the biggest adjustment is to subtract any increase. Can you see it here? Any increase in property, plant, and equipment at cost. This is the big one here, and it's easily calculated. Go and take your PPE now and subtract off your PPE the year before, and that is subtracting off your CapEx. Now we're ready to add those all up, and it's easy. Net profit after tax, pulling down from the income statement, add back the depreciation, add back interest expense after tax, subtract out the interest income net of tax, subtract out any increase in current assets, add back any increase in current liabilities, and most importantly, subtract off the CapEx. And we're left with a free cash flow. Copy this right. Got free cash flows, guys. This is your first FCF. Discounted free cash flow, not discounted yet. We're going to have to discount these values, and that's what we do in the next slide. Now, I just want to talk to you about this discounting. There's some little tricky things. You know, let's say we've got a year here going from date 1 to date 2, and this is the year end, and in this year we have a free cash flow 2, let's call it. It turns out that we shouldn't be applying the free cash flow 2 on the end of year date, because it doesn't all happen on one day at the end of the year. Our business happened to be spread out sort of evenly during the year. And so, in fact, we should be applying our free cash flow at the middle of the year. And so we make what is known as a half-year adjustment. And that half-year adjustment is made to the discounting. You don't want to discount the free cash flow from that date to back until today. You only want to discount it from the middle of the year back until today. So you want to actually avoid half a year, 6 months of unnecessary and incorrect discounting. And this can actually give you half of your whack back. And this applies for every single period going forwards. So that's one adjustment you have to make. The second adjustment, which is usually to one of your biggest free cash flows, is this one in the current year. You find the current year, which is this full year here, you're actually halfway through it, say. So you really need to only take 6 of the 12 months. So you need to multiply your free cash flow 1 by 6/12. And then still, you need to make not a half-year adjustment, but a half a period adjustment. In this case, 3 months. There's lots of subtracting dates and pro-ratering, and it's a bit of a mess. So instead of you having to do it yourself in Excel formula, we've made a PV, a free cash flow function for you. And this function, you remember when you did the VBA functions and you dragged and dropped all of those macros? This is a function that came across. So you've got it already. It takes the cash flow, the date for that cash flow, the length in the period, like 365. The fourth parameter is the date that you want to discount back to. And the fifth one is your discount rate, your WACC. So it's as easy. Let me put my cursor there and press F2. And here's your function, PV of free cash flow. And you are going to give it the free cash flow. That's the line above. And you're going to give it the good old the date. Remember the date in row 3? Here we go. We also got to tell it the period. So we're going to say, okay, give us the date now minus the prior date, which is the last of the year before. And it'll usually tell us it's 365. And 2 important ones here, the valuation date. And I've set that up as this date. You'll see it's actually a single cell. And I just put today in there as its function. And similarly for WACC. This green one is my WACC. And it's a single cell. It's not a whole row. So in one click, and you get the whole thing copied right. Now you are ready to go and add them up. So our present value of our first 10 years is merely the sum of that row 119. Sum PV FCF. Just before we go, let me show you, that's the valuation date. That's my WACC. And this is my terminal growth rate. Okay, that terminal growth rate is actually, it's TGR and Alt MP. It's all the way back up there, and you'll see that this line fills in there, and it's referring to our last sales growth. Our last sales growth rate is the rate that we're going forward, and it's our G. So we've added up the first 10 years. Now we have to do a terminal value. Terminal value. Hey, we're going to use our PV of free cash flow formula again to do the discounting and adjusting for us. But in the formula, we're going to take our last, this is our free cash flow in year 10. See it over here, V118. And if I grow it by 1 plus G, that will give me my estimate for free cash flow in year 11. And so then I can divide by my K minus G, or my WACC minus growth, and that will perpetuitize it and give it to me in year 10. So now I'm ready. I'm going to give it the date. D3 is the date in year 10. I'm going to give it the length of years then, because that's what I'm using up there. And as per usual, the valuation date, and as per usual, the WACC. I can add these two together, my near model and my terminal value. I found 7 billion, and I'm going to show you that 38% my value of my company is in the next 10 years. And then in the next million years, whatever, from 11 onwards, 61%. So that's quite a chunk. Okay, and maybe I should have more forecasts. A lot of this value is coming later, but this is how you get a sense. That's the core enterprise value. That's the value that we get from free cash flows and running the business. But the business is not just the running of the business. There might have been some spare cash lying around. There might have been some investments in other things. And so we have to take that number, take our enterprise value, and this is our spare cash. I'm going to add any spare cash and any investments and loans. It's very useful that we are working in column L, our last known historic year, because we can then just refer to these things. Cash and equivalents, required cash, investments and loans all go and resolve themselves by intersecting with those rows in this column. So do all these calcs in this column. Right, we're rich, 8 billion. That's an enterprise that's supported by the two pillars of equity and debt. Well, we want to remove the pillar of debt. So we're going to go and calculate how much debt there is, long-term debt and short-term interest-bearing debt, and it comes to about 3. And if we subtract that, we subtract 3, the value of debt, from the total enterprise value, guess what? We get a value of equity. Unencumbered value of equity, finally. Right, 4 billion, that's a lot to go around. But unfortunately, there are 870 million shares that it's going to be divided into. So we're making our last use of MacFaz. And MacFaz is going to go and use its share code, the MacFaz code. And in this instance, guys, I'm choosing valuation date. I really want the number of shares that are available at the very latest, please. Not just at the year end. Whoops, I made a mistake. Yep, I have to have that 10% in front. Right, look at that. Divided out, equity value divided by number of shares. I get 5 Rand 43, and I can now go and compare it to what it's trading at in the market. Wow, I found something that I think intrinsically, fundamentally, is worth 5 Rand and 43 cents. Don't forget the 3 cents. And I think I can go and sell that in the market. I know I can. It's trading at that, 9 Rand 50 today. Well, 27th of May. If I found that my value was more, well, I would then go and buy in the market at 9 Rand 50, something that I thought was more. The way we're going to go and get the market prices, you're going to use your Yahoo Finance time series value function. You're going to go and install that Yahoo add-in that you've got in your folder. Let's have a look here. That share code that we have, which is RCL. And does this work? Yes, RCL. We need to convert it. We need to convert this thing using this function into its Yahoo code, which is rcl.johannesburg, I guess. And that, we then need to tell it, do we want the high, the open, the low, the volume, or the closing value, which I want. And when do I want it? On the valuation date. Now that's going to give me a share price in cents. So I'm going to divide by 100 to make it rands. 9 Rand 50. So if my model share price is greater than, it's a buy, but it's less than, so it's a sell. How about that, guys? We finally reached a share price and a recommendation. Can I give you a bonus? I want to show you a bonus thing. I want to show you something. This is a big spreadsheet now, eh? Look at it. It's got all this stuff in it. It's just piles of formulae. I want to go and I know how to break the spreadsheet. I know that if I put in a 0 growth rate here, I think it breaks it. Look what's happened to my spreadsheet. I should never have done this elective. Let me just put this back to 1% or whatever quickly. And it's still broken. And no matter what you do, this stays broken. This is the bonus tip, guys. What to do. Don't panic. You're going to go and press your Alt F8 key. Alt F8 key, press your tab, and you're going to look at these things. What? Fix hash names. Have we got a bunch of hashes all over the place? Hashtags everywhere. Please, can you just press run? No ways. Wow. 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 I don't want to do that too often. Okay, look at that. Are we getting the same price? Yes, we are. Okay, so don't forget that cool bonus trick. If your spreadsheet just breaks all of a sudden, or you break it, what's happening there is the circular references are passing around your error, backwards and forwards, left to right, around and around, and that Excel can't resolve itself. It can't settle down. It can't iterate. So that macro knows what to do and goes and fixes it for you. It saved my life countless times. Right, I'm going to call that a day and say I really like rainbow chickens. I've been valuing it since 1997 when I first did my MBA. It was my final year, and we had to do a valuation product, and I've still got my spreadsheet. I'm not going to show it to you, but it was on rainbow chickens. Right, until next time, we will say adieu.